Right. So once again, warm greetings to you, colleagues, and I would like to welcome you to our lecture 6 in this first semester of the 2024 academic year in AUI 3702. So what we are going to be looking at in this particular engagement, and this is video A of this lecture, we are going to be unveiling the business cycle entitled Revenue and Receipts Cycle. So that's what we are going to be discussing in this particular engagement, right? So you'd discover that like any other business cycles, right? Revenue and receipt cycle, it's made up of different functions or different stages, as we'd call it, right? So there are several stages, like in the as you can see displayed on your screen, that are performed when you are following the revenue and receipt cycle. But let's also get to a point where you have an understanding as to why do business affect a revenue and receipt cycle in their operations, right? So essentially, the purpose behind this particular cycle, a revenue and receipt cycle, is just for us to be able to give account of how a company or a business organization is generating revenue. What is the process that they followed in order for them to recognize revenue in their books at the end of the day? Now, there are two things, or rather two ways by which a company could generate revenue in this context on the basis of the principles of revenue and receipt cycle. They can either sell a product, meaning something physical in nature. So they would sell a product to their customers, or what we would normally regard as the end user, right? And in turn, they would receive money or payment for providing or selling the product to the customer. That's one way. The other way, it's either they will be supplying or offering a service to their customers or to their clients, as it were. And they'll be receiving revenue in form of fees or service fees, as we would call it. But then you would discover in the context of an examination, you can get either of the two, where they would give you a scenario describing what the organization is offering to their end user or to their consumers. So it can either be that they are selling a product physical in nature, or they are providing a service to their targeted market, which is the consumer in any case. But in that process of selling the product or providing a service to the consumer, what are those essential stages? What are those essential steps that they would follow for them to recognize revenue in their records? And that's where this particular cycle, revenue and receipt cycle, becomes handy. Why? Because we need to be able to have proper accountability of how we are generating revenue as a business. So for us to do that, we need to then have an understanding of the cycle, revenue and receipt cycle. So as you can see depicted on your screen, and I'm also going to take you through your prescribed textbook. Hence, I opened it here because I wanted to just show you the same stages or phases in the cycle in any case. So obviously, the first one being receiving and processing of customer orders. So receiving and processing of customer orders is what I've depicted here as ordering. So what is simply taking place there is a phase in the cycle whereby the organization would receive a request for a service, or they would receive an order from a customer for certain products, that they would want to acquire from the organization. So obviously, when that takes place, we need to be able to recognize their objective. Why do we need to have this particular stage in the cycle? What is their core purpose of existence in the cycle? Which individuals, department within an organization would participate in that regard? So obviously, would expect to see, for instance, the likes of a customer sales personnel. Would expect to see marketing or sales department being actively involved in that process. So obviously, There will also be certain documents and records that they would need to maintain, all right, in order for them to give account of the number of orders that have been received and processed for customers, right? And then, of course, from an auditing point of view, this is now where we come in. We should be able to evaluate the ordering process or the processing of customer orders and be in a position where we can identify possibility of things going wrong. And that's where risks come into the picture. But as you can see, the ones that I've given here, they are not fully comprehensive, but I just simply depicted something so in a way to give you guys an idea, all right, of what can actually transpire at that particular stage of the cycle and how you can be able to, you know, to control or to mitigate such identified risks thereof. So I also indicated the internal controls that can be put in place in order to address those identified risks. But it's not only limited to that, because in the context of an examination, they can also ask you to identify weaknesses with respect to the ordering function or the processing of customer orders within the revenue and receipt cycle of a particular organization. So at the end of the day, you should also be able to, you know, to identify such probable weaknesses there, right? So without any further ado, let me just quickly take you to the blueprint first, and then I'll come back to my notes so you can be able to see how the two correlate. So like I said, the first stage is receiving and processing of customer orders. Second stage therein is granting credit to customers. So that's pretty much granting of credit. Third stage, there it's shipping of the product or delivering a service. Like I said, with revenue and receipt cycle, it's either you're dealing with something physical that you're selling to the consumer, or you are providing a service to the consumer in that case. So obviously, the third stage, it has to do with now you providing a service to the consumer, or you are simply shipping the actual product to the consumer there, or it's delivery to the customers. Fourth stage in the cycle, it has to do with invoicing the customer and also recording the sales in your accounting records, right? Then followed, of course, by collecting debtors' payments. So after you have invoiced the customers for the service or for the product that you have offered to them, you need to then, of course, initiate the collection of payments. Supposedly you had sold the product or offered a service to the consumer on credit, you need to ensure that you've got appropriate measures of following up on payments from your debtors. And that's what 3.2.5 deals with. And then in certain circumstances or certain instances, you might have circumstances whereby a consumer may not be happy with a service or may not be happy with a product that you've sold to them. So that's where goods return comes into the picture. So what are the procedures according to the blueprint that should be followed by an organization when they are handling goods returned by a consumer as a result of either that the product was not meeting up with their standard quality or expectations, normally because the product that you sold or delivered to the customer was damaged or of a poor quality standard, right? Or there could have been in a case whereby there were shortages of stock in the boxes maybe, which would result in the customer not accepting the delivered goods, but rather would initiate to return the goods back to you, right? So these are the activities, the functions that you would find when you are dealing with the revenue and receipt cycle. But remember, the most important things here that you need to be able to do at the end of the day is the following. I'm just going to quickly try and point them out to you before I show you the blueprint of this, right? So the things that the examiner is expecting you guys to do is this. So I'm going to write them down just now. And I'm writing this because I want you guys to have direction when you're doing your own personal studies of the cycle. So obviously, here's the thing. Number one, you have to gain understanding of what is happening in the stages there, all right? Or the functions, or what I would normally regard as the phases within the cycle itself, all right? That's the first point of departure, to understand the respective functions, phases within the cycle. How do you understand the stages, the functions, the phases within each one of those cycles? First of all, you should be able to define the purpose or the objective of each one of those respective stages or functions or phases within the revenue and receipt cycle. That's number one. Number two, you should be able to identify, all right, personnel, or should I say people involved, and under normal circumstances, you can also quantify them or classify them rather into departments within the organization. Now, why should you be able to identify personnel or departments? So that you can be able to know who to give account of certain, maybe certain weaknesses that might be occurring in the process of what is it? In the process of selling a product or in the process of providing a service to the customer. So you need to be able to know, okay, who is accountable for this, right? And that's the purpose of being able to identify personnel or departments that are involved in the process, right? Now, once you have established that particular fact, the next aspect, obviously, is to be able to also come to a point where you identify the form of documents. Not only that, transactions, if any, and normally with transactions, what should come into your mind is that we're talking of a monetary historical record, okay? The moment you hear them saying the transaction, just know that we're talking of something that involves a monetary historical record, right? So that's transactions. So I would normally combine this with records. So a records, obviously, is when we put different forms of transactions into a report. So it will form what we call a record, all right? Now, very important, why is it so that you need to be able to know the forms of documents that are being used at each one of these respective stages of the cycle? Or why should you be able to know the transactions that are recorded or captured, especially which involves monetary historical records? Why is it important that you need to know that? So that you can be able to identify risks in particular, all right? And also so that you can be able to identify weaknesses, because normally it will be associated either with a particular transaction record or a set of transactions in that regard. So it could be that there are fictitious transactions that have been recorded. Now, if for us to be able to know that there are fictitious transactions captured somewhere in the company's records, normally those transactions would not have any form of supporting documentation in place. So that's why documents and records are important for that purpose of evaluation, right? Then, of course, once you know the purpose, objective, by being able to identify people involved, the documents and all of that, this also kind of like helps you to understand the standard policy and procedures that are being performed at each one of these respective stages of the cycle, right? Then here comes what I would then call the assumed knowledge, meaning things that the examiner is highly likely going to test you. So I normally regard to this as assumed knowledge. Right. So the assumed knowledge comes in this way. Number one, here's what they will ask you. They will definitely ask you to identify weaknesses. That's a fact. These things I'm showing you, they are most applicable to almost any one of the business cycles that we're going to discuss about, right? So they'll ask you for that. Then, of course, they'll also ask you to identify risks at any one of these stages of the cycle. Number three, then they'll ask you to give recommendations, and normally when they are asking for you to give recommendations, they are simply saying draft mitigation measures, right? So mitigation measures, they are aimed at addressing a problem. And the problem here can either be a weakness or it can be a risk that is taking place within our process of revenue and receipt cycle in that case. So essentially, these mitigation measures, they can also then be attributed to internal controls. Internal controls. And I just want to open your eyes to something. With internal controls or these mitigation measures or recommendations, as it were, need to understand that depending on the form of system that the organization is using, you should, it's one of the most important things that when you go through a scenario, you identify the type of system that the organization is using. Is it perhaps a manual system, or are you dealing with something that is within a computerized environment? So meaning to say we're dealing with a computerized system, right? In as much as we can have people being involved in the process, but under normal circumstances, when there's computerized system in place, there's less human involvement. But then, of course, for the reasons of monitoring, reviewing, and all of that, you then get to have the involvement, and of course, processing, initiating of the transaction. You get to see the involvement of a human being in that regard. But essentially, why I'm saying that you need to know, to identify the type of system that is used, whether manual or computerized system. It's important so that you know the suitable internal control measures or mitigation measures to recommend for management to address their problem. Because their problem, it could be something that has nothing to do with what is happening in the computer system. It could be something to do with what personnel is doing, maybe because there's lack of segregation of duties, maybe because there's lack of rotation of duties, right? So if there are circumstances like that, that may not necessarily need you to be recommending a mitigation measure which has to be programmed in the system as such. But it could be just an issue where you will have to say management should consider deploying segregation of duties, right? Or rotation of duties, something like that. So that may not need an involvement of a computer system as such. But then the moment we see that the problem has to do with the transaction that is being processed in the system, that's where now we can think of controls that are associated with a computerized system itself, meaning to say controls that can be programmed within the system. For instance, where we can recommend to say management should consider, right, should consider programming application controls such as, and then you start giving examples within a particular field such as 1, 2, 3. So maybe it could be, for instance, when you guys are initiating your registration process for a particular academic year, right? In that process, you notice there are fields that you're expected to complete as a student, right? It could be, for instance, your name field, your surname, your contact details, your address, and all of that. Now, if you try to process the registration process without filling any one of those fields, you discover that the system would produce an error report. Why is it that the system is producing an error report? Simply because there's application controls that have been embedded within that system to prevent processing errors during the registration process. So it's the similar depiction that, similar approach rather, that we should also use even when we are evaluating any other system, which could be different from the registration process as it were. For as long as we are able to identify what set of system are they using in their revenue and receipt cycle. Is it just simply manual based? Is the problem to do with their manual system, or is the problem particularly relating to the computerized environment itself, right? So it's very important, guys, because this is typical things you can be tested upon, right? So I just thought I should emphasize on that. So now I want to quickly take you to the first stage. Of course, I've done the summary over here, but the reason why I'm taking you through the textbook is because there's some things I just wanted to explain and emphasize to you guys. No wonder I was putting this down to you, right? For instance, purpose, objective of this, of each one of the stages in the cycle, I did not necessarily embed them on this notes, but there's updated version of the notes that I'm going to give you guys by Saturday, right? So it will incorporate that. But I just thought for the sake of continuity, I can just explain even by navigating through your prescribed material, right? Are we together so far, colleagues?
Yes, so far.
Okay, wonderful. So I'm gonna quickly take you to page 94, just to show you something real quick. Page 94, right? So why I'm taking you through that is simply because I want you guys to understand the blueprint of this particular stage in the revenue and receipt cycle. What is it? So when I'm saying blueprint, I'm simply referring to what is it that is supposed to be taking place according to the prescribed text, meaning your text. This thing that you're seeing here, which I would call the blueprint or prescribed text, it's things that are happening even in practice, according to what should be happening according to standard practice, even in the corporate world. This is what they are supposed to be doing. So for instance, when we are receiving and processing a customer order, all right? Under normal circumstances, it happens in any of the following ways that you are seeing here. An order can either be processed by, it can be processed via the telephone. So who is initiating the order? Obviously, it's the customer initiating the order, and there are ways of doing so depending on what the organization is using. So the order can be taken either via the phone, which is a bit outdated as of late, but there is also other means, meaning to say, for instance, a customer could actually initiate the order in person where they will come to the store and they would request for a particular product that they would want to buy from the company. Or, and by the way, this one is a common one, the in-person method, because a lot of people, when they want to buy, products, they would go to the store physically, right? But obviously, things and times have changed. We also have orders being processed via the internet. And when it's happening via the internet, what that really refers to, these are like what I would call online orders. So these are like online orders. So online orders happen, can take place in different platforms. It could either be through the company website, or it can happen, through other means. So when I'm saying other means, it could be maybe they are using a third-party facility to facilitate the ordering process, all right? Think about it in this context with Uber Eats, right? Now, how many food outlets out there are using Uber Eats? For you as customers, myself included, to initiate orders for food items, how many of those food outlets are using that? You find that it's quite a number, right? I'm not going to mention names, but it's quite a number of food outlets you can find on Uber Eats. And what happens is you initiate your order there from any one of the food outlets of your choice. Not to say that some of those food outlets, they don't have an option where you can place an order on their website, for example. There are some that have advanced to that level, but under normal circumstances, these things, you see them on a day-to-day basis, where you can place an order over the phone, or you can just simply go to the stores in person yourself, or you can do the processing of the order online. But now let's understand, okay, when all of this is taking place on the company side, who is the responsible person that is supposed to be receiving and processing this order? There has to be a sales clerk, or essentially there has to be a sales department or marketing department, which is responsible for receiving the order. So in other words, they're the ones who are supposed to confirm the order that has been initiated by the customer. And how do they confirm? One of the things they will do is to assess whether there is availability of the stock or the item that the customer is requesting for. Or it could be maybe to assess whether they can be able to meet up the service request of the client before it is even actually processed. So those are some of the important things I want you to, some details I want you to pick up, that before a customer order is processed, all right, or even approved, one of the things is, if it's a product, we have to assess, check, all right, or assess whether we have got the availability of stock in order for us to complete the order. Because imagine if you just take the order without verifying the availability of stock, guess what's going to happen? The customer will be waiting, expecting their goods to be delivered in a particular set time frame, but you will not be able to meet up to that demand. And failing to do so means that's going to result in customer dissatisfaction. I'm talking of risks in that particular stage. Customers will not be happy. If customers are not happy, guess what's going to happen? You're going to end up losing revenue as a business. And not only does it just result in losing of revenue, but your reputation, it's on the line. Why? Because customers will discuss, say, no, these guys are not reliable, don't buy from them. You get what I'm saying? So all these things are probable things that take place during the receiving and processing of a customer order. No wonder on my notes, you notice when it comes to personnel involved, there's the involvement of a customer, there's an involvement of a sales clerk or an order clerk, depending on which department it is. Sales clerk, normally if it's sales department, order clerk, normally if it's the marketing department, okay? So, but in any case, those are the personnel you would see actively involved. But remember, there's need for authorization to take place. Okay. So yes, as much as you can have a sales order clerk, you can have a customer order clerk, they need to receive authorization from somewhere. And that's why we need to have a manager. So it can be a sales manager, it can be a marketing manager at a seniority level, who then approves or authorizes the processing of a customer order after those confirmations, such as the confirmation of the availability of stock has been processed. Okay. Now I'm gonna just show you a few other things, to indicate the issues of documents, right? So obviously, notice only authorized senior personnel may update the price list. All right. So in as much as you can take orders and then check for availability of goods and all of that. One of the things that customers would likely ask you as a sales clerk or as an order clerk, they will ask you for the prices of the item they want to buy. Question is, what is the source of reference you're going to use for you to confirm the prices? There has to be what you call a price list. So in terms of documents, that's why you notice under documents and records, I indicated number one, there has to be a customer order which will be filled by the customers. Then there has to be a use of price list. And then of course, a use of a picking slip. So I'm just trying to indicate to you why price lists are important, why customer orders forms are important. That's what I'm just trying to also show you from the blueprint. So notice, upon the availability of inventory or a service personnel, the sales clerk, what does he do? He or she would prepare an internal sales order. So that's what I'm referring to here as the customer order. So it's just the internal sales order, right? So obviously it will be prepared, and notice there are 4 copies that are generated. There's just one document I forgot to indicate here, is the quotation. Because not all the time would a customer call just to buy immediately. Sometimes they can just request for a quote before they can initiate their order, right? So it's another document you can find during the ordering. So it's quotation as well, right? So now I want to show you in figure 3.2, the flow of transactions and documents with regard to processing of a customer order. And I'm showing you this because it's very important, because when you go through a scenario, you might just be told, yeah, and then there's, when the sales order clerk receives the order, he or she would record the order. He or she would record the order on a notebook, right? So now if you are recording an order in a notebook and you're not using a standardized document, all right, that alone, it's a weakness. It's inadequate recording, right? Inadequate record keeping, right? So obviously that goes against the blueprint, because when a customer initiates an order, all right, here's what's supposed to happen. The responsible personnel, all right, should prepare an internal sales order only after they've checked for the availability of goods. So this internal sales order you are seeing here, and notice how many copies there are. there's about 4 copies, including the original. So there's an original, there's a second duplicate copy, third duplicate copy, and the fourth duplicate copy. And all of these, they are generated for a specific purpose. Now, the first one, which is the original, it's issued to the customer, the one that has initiated the order. No wonder when you go to your food outlets like Roman Pizza, when you go there and you are buying your pizza, what do? They give you the till, there's a slip that they give you there. What do you think that document is? That's your sales order there that they're giving to you, okay? Already invoiced and paid under normal circumstances. So why? Everything is happening in real time. Okay, everything is happening in real time. So number one, they've already processed your order, number one. Number two, they've already invoiced you. Number three, they also have receipted you at the same time. All right, why? Because you have paid for the order immediately. Everything is happening in real time. But then there are circumstances where there's credit, involvement, right? So normally when there's credit involvement, colleagues, what would normally happen is the payments will obviously be done at a later stage. And in terms of our record keeping, it will not be done immediately, such as in the case where there's real-time sales taking place, right? Just let me class that out. Get back to you. Right. Right. So hey, sorry about that, guys. Somebody was trying to call me. Right. So I mentioned that the original is sent to the customer, then there's a copy that's issued to the warehouse. Okay, I want to explain why these copies are there. So the one that is issued to the warehouse, it's not just issued alone, it's issued with what you call a picking slip. A picking slip is a document authorizing people in the warehouse section to be able to collect the relevant goods that have been ordered by the customer. That's the purpose of a picking slip. But it doesn't go alone. It goes with a copy of an order form. So when the people in the warehouse are selecting the relevant goods ordered by the customer, they would use a picking slip so that we can keep track of our inventory. That's the purpose of a picking slip. So we know, okay, how much stock was taken out for sales, how much is remaining, and all of that jazz, right? So a copy here for the sales order is used just so that we can be able to authorize warehouse personnel to pick the relevant ordered goods by the customer. Then there's a third copy, which is titled N here with a triangle. That one is maintained in the sales department for record keeping purposes. So that's what that N denotes. It's just for record keeping purposes, right? Then there's a fourth copy sent to the accounts department. Remember, at some point, the customer has to pay. So when the customer is paying, we need to be able to verify the payment, to say, did the customer pay the correct amount based on what they've actually ordered, or are they underpaying for the goods that we have already delivered to them? So for us to be in the position to confirm, we need a copy of the initial sales order. That's why it is sent to the accounts department, right? So guys, you need to understand the flow of documents. Why? Because in the flow of documents, you are able to know where a weakness is taking place. It could be that there's just one copy that is being generated. For example, if you record the order on the notebook, so what are you giving to the customer so that they can be able to follow up on their order? Do you see that alone? It will be a weakness, you see? So such things like that, guys, those are things you need to give attention to. All right. In video B, I'll be proceeding with stage 2, granting credit to customers. And so basically it is this one here, granting of credit to customers. I'll talk about risks and all of that afterwards. All right. So let's reconnect on the same links, colleagues. Thank you.